Good evening, everyone. Time for another silver update. This is the 2-hour chart of silver provided by netdania.com. You can click on the link below. Now you can see the silver price is hovering about that $20 price. We had the big Fed news today. We're going to go over that. But you can see that we had about 600,000 contracts change hands today, and the market was very erratic. We'll see that when we move close up. That's going to come to about 3 billion ounces of silver. So if you can imagine that somebody decided to sell 3 billion ounces of silver, remember that silver is only mined at a rate of about 750 million ounces a year, so that's 4 years silver supply changing hands in one day. Now if we go over to gold, you can see something similar. That's kind of interesting, because if you add this up and multiply it out, you get about 300,000, about 275,000 contracts, multiplied by the 100 ounces of gold that are in the contract, and multiplied by the price of gold, 1,200. We come to about a $30 billion price tag. You can see these volume spikes are very, very high compared to past volume spikes. So about 30 billion ounces of paper gold changing hands, and $30 billion of paper gold changing hands, and $3 billion of paper silver changing hands. Now, we know that they're both fake. They're fake markets. But it's interesting, first of all, because it's a 10-to-1 ratio, and we know that that's roughly the ratio that it comes out of the ground at. So the market, even in its rigging, kind of gives lie to the ratio that we have, more than 50-to-1. But let's zoom into the 1-minute chart and take a look at this type of erratic behavior, and you can see a huge rally, or a small rally, huge sell-off, rally, huge sell-off, and now we're starting to rally, and it's just one gigantic fake market. The computers are in there trading back and forth. They take the price to where the Federal Reserve wants it to go, and pretty much they want it to go sideways. Now, if we look at the currencies, you can see that the euro lost a lot of value against the dollar as an end result of this, and the Japanese yen lost a ton of value as a result of this. So again, this is all just manipulation by central banks. You can see the volume in the yen is very, very large, not larger than the past historical spikes, but a very large spike. So what's behind this? Well, what's behind this is that the Federal Reserve is trying to get itself out of the box that it's in, and we know that it's impossible. The only question is who's going to take the fall when this entire system collapses, and it's going to collapse. Let's jump over to debt to the penny. If you don't know how to do this, what you do is you go to debt to the penny and you choose your dates. I always choose today, a year ago, as the beginning date, and today as the ending date. Then you take the national debt a year ago and look at the national debt now, and you've got roughly $900 billion. So they're still adding $1 trillion a year to the national debt, and Mr. Bernanke's going to convince us that we're tapering. So let's look at that story. Fed cuts bond buying in first step away from historic stimulus. Bernanke doesn't look too confident there. Hopefully he's thinking he can get out before the trouble starts, and maybe he won't have people chasing him with pitchforks and torches. So let's read the story here. The Federal Reserve on Wednesday embarked on the risky task of winding down the era of easy money. Well, no, it's not winding down the era of easy money. It's winding down money printing. Easy money is 0% interest rates. We're going to find they're not even going to touch those. Saying the U.S. economy was finally strong enough for it to start scaling down its massive bond buying stimulus. Well, we know that the economy is not strong. It's anything but strong. But they're reporting using fake numbers to try to imply that it's strong. The central bank modestly trimmed the pace of its monthly asset purchases by $10 billion to $75 billion and sought to temper the long-awaited move by suggesting its key interest rate would stay at rock bottom even longer than previously promised. At his last scheduled news conference, as Fed Chairman Ben Bernanke said the purchases would likely be cut at a measured pace throughout much of next year if job gains, fake job gains, continued as expected, with the program fully shuttered by late 2014. So think about that. They're saying that they're going to end the tapering by the end of 2014. That means they're going to have to cut the same amount, roughly, that they did this time every month or every other month to have that happen. We'll see how the markets react. The move, which surprised some investors but did not cause the market shock many had feared, was a nod to better prospects for the economy and the labor market. It marked a historic turning point for the largest monetary policy experiment ever. Quote, "The recovery clearly remains far from complete," Bernanke said, "but we're hopeful we'll begin to see the whites of the eyes of the end of the recovery." Now, what kind of a statement is that? The end of the recovery is going to be the beginning of the next recession. Is he giving a hint there? And the beginning of the more normal period of economic growth. Well, that's ridiculous. We know that recessions happen normally 3, 4 to 6 years. We're already 5 years plus from 2008. The official beginning of the last recession was December 2007. So we're going on 2014. I don't know what he's talking about there. Bernanke said he consulted closely on the decision with Fed Vice Chair Janet Yellen, who is set to succeed him once he steps down on January 31st after 8 years at the helm. Quote, "She fully supports what we did today," he said. And so you can read the rest, especially the comments, because most of the comments are negative. These are people who aren't really fooled by this nonsense. But let's look at this video that was posted on Zero Hedge. This is from Punk Economics. This gives you a better idea of what we're talking about. And by the way, if you go and take a look at the Dow's reaction, we had the expected, which is more paper rallies. And that's the way it goes. Smack down real assets and rally fake assets. That's their pattern. So let's watch this.
Patriotism. Today's kidnappers are the financial markets. Today's ransom is the billions of dollars in the form of QE. Today's hostage is the US economy, which the kidnappers threaten to kill via a collapse in asset values if they don't get more and more free money. And who is paying the ransom? It is the Federal Reserve, led by the mild-mannered Janet Yellen, of course. So the message from Wall Street, the kidnapper, is:
if you don't give us what we want, we will kill the economy. And you don't want that to happen. Not on your watch now, do you, Mrs. Yellen? And you might think we are bluffing. Well, you saw what we did last summer, when you guys thought you could push us around. We sold off and put the fear of God into your predecessor, Mr. Bernanke. And that was only child's play to what we could do this time. So come on now, Janet baby. Pay up and nobody's gonna get hurt. You know you want it.
And guess who gets all this money? All that $85 billion ransom that's paid over every month. Now that's a lot of money. That's over $1 trillion a year. And in a $16 trillion economy like the US, that's a lot of bread. So you get it, don't you? Nah, they do. The kidnappers get the cash. Of course they do. The money goes into the banks and doesn't find its way down to the working man. Don't be so silly. It drives up asset prices. And guess who owns all the assets? Why? The rich guys, of course. An increase in asset prices, as opposed to increase in wages, that's what makes rich people even richer. So don't get us wrong, we at Punk Economics, we believe in competition and trying to do our best. But this isn't the market in operation. It's old-fashioned extortion. When we were kids in Ireland, our parents used to tell us that our democracy should never negotiate with the kidnappers. And we'd asked why. Because, little man, our dads might tell us, if you pay these bad guys once, they'll kidnap again and be back for more. So welcome to the weird world of QE to infinity. Follow us on Twitter at Dave.
And there you go. That's the bottom line. QE is about giving more money to the banks who turn around and buy more stocks and, of course, short more silver and more gold. We know that this is going to end very, very badly because ultimately it has to collapse. There's no way it can continue forever, but the question is, whose watch does it collapse on? Because whoever's watch it collapses on is probably going to be going to prison, if not having people chasing them with pitchforks and torches. They're going to evaporate all retirements. They're going to steal all the 401ks. They're going to steal everything that isn't nailed down. So hopefully you're going to invest in something that is nailed down and is better than nailed down, is hidden away. That's going to be physical gold, physical silver. Grab a couple Bitcoins, grab some preps, grab anything that they don't control, that is not made of paper, that is not somebody else's debt obligation. Because yes, they succeeded today in pumping it one more time, but ultimately it's going to collapse, and when it does, there isn't going to be anything left. And we'll talk to you next time.